Good morning, good afternoon. It's a pleasure being here. I really appreciate this invitation from FLAR again to participate in this time in a virtual event that is actually precedes a very important in-person meeting in Cartagena that has been actually missing for many years. So I thank you very much for this invitation. My name is Marco Ruiz. I work in RAMP, in the Resource Advisory and Management Partnership. And I'm here actually to talk and to discuss with Andrew Ang a lot of things. I think probably two topics that are very relevant for investors nowadays. So the first one is climate investing in fixed income. The second one is asset allocation with crypto. It's two topics that are actually are quite interesting to the audience and any investor in general. So let me talk a little bit about Andrew. So Andrew currently is the head of Factors, Sustainable Solutions for BlackRock Systematic. He does a lot of things basically in the team. So probably just to summarize it, he uses a lot of quantitative insights and to apply it into products that BlackRock actually creates. So I think it's a very interesting perspective that Andrew has in terms of integrating academic insights into actual investment practice. And I think that's probably where we should take advantage of Andrew here. Andrew is also a very prolific writer. He has over 100 publications. His book, Asset Management, A Systematic Approach to Factor Investing, is considered a Bible among many quantitative investors and quantitative people basically in the world. And before joining BlackRock, Andrew actually worked as professor in Columbia, where he covered a lot of issues in finance and investing. Notably, and I think very important for the audience here, he also spent some time actually doing research in terms of sovereign wealth funds, which is actually very relevant for many of the participants here. So let's, without further ado, so let's get started. So Andrew, over to you so that you can actually go over your slides. And then after Andrew's slides, we will proceed with some discussion. And of course, we'll open up for questions from the audience.
Thank you very much. And it's a real pleasure to be with you. I'd like to cover, as I mentioned, two topics today, which is climate investing in fixed income, including generating alpha in fixed income using ESG signals. And then I'd also give you a framework to think about asset allocation with cryptocurrencies, and we'll concentrate on the crypto with the longest history and the most established one, Bitcoin. All right, so let's turn first to a paper called Sustainable Alpha in Sovereign and Corporate Bonds. There's a link to this presentation. If you'd like to receive the paper, then please let me know. But you can see link to the paper in the presentation. So this is recently published this year in the Journal of Investment Management, along with other colleagues in BlackRock. So I want to look at first how to design a climate-aware fixed income portfolio. And then I'm going to turn to corporate bonds about how to generate alpha signals with climate variables in the second part. Okay, climate it's an existential topic for us, and I think many of your countries are at the forefront of managing the risk of climate change. With the various climate scenarios, the most ambitious one is to limit average global temperature increases to well below 2 degrees. This is called the Shared Social Economic Pathway, SSP1 -1.18 in the IPCC, which is an organization of scientists and governments focused on climate change. The only way that we can limit the average global temperature increases to well below 2 degrees and try to aim to 1.5 degrees is with a particular pathway of carbon reduction. And that pathway is a 50% fall or drop in climate emissions, carbon emissions today, and then to get to net zero by 2050. So that is the same amount of carbon in steady state, carbon dioxide in the atmosphere in steady state as pre-industrial revolution over 1850 to 1900. We need to go to a net zero or zero net emissions by 2050. So that second part is accomplished by 7% decarbonizations in comparison to self by 2050. So you need to cut carbon emissions by 50% and then cut them continually by 7% every year. And that is the only way that we can, as a society, limit the average temperature increases to well below 2 degrees. In order to do this, there have been a series of guidelines that have been issued by some investment organizations and by EU regulation. So we're going to follow those guidelines that are set by the EU Technical Expert Group on Sustainable Finance, or the EU TEG, and we also will follow a set of guidelines issued by the Institutional Investors Group on Climate Change, the IIGCC. And here I note that we have a board member, one of our senior executives, Sandy Boss from BlackRock, is on the board of the IIGCC. So how do you actually do this? Okay, what we need to do is to cut carbon emissions by 50% immediately and then 7% year on year. But would like to have several other things in the portfolio as well. We want to make an emphasis on those issuers that are forward-looking. We want to emphasize countries that are better equipped to handle that climate transition, and also tilt towards issuers that have committed to reducing carbon themselves. It has to be guided by science. It has to evolve as the world evolves too. So let's turn first to, I think, the most important part of your portfolios, which are sovereign bonds. How can we get a climate-aware solution for the most important part of that portfolio, which provides defense, liquidity, reserve protection, everything else that we need in our central bank portfolios? All right. So the way that we do this, according to the IIGC guidelines, we're going to take a benchmark. And that benchmark might look something like a AG. It could also be some other type of sovereign benchmark. And then relative to those benchmark positions, we're going to tilt towards countries that have lower greenhouse gas emissions, countries that have built in more renewable sources of energy, use energy more efficiently, and have climate policies for that country that help them to adapt and mitigate the effects of climate change. So all of those things will go into now an optimization relative to that benchmark. And the optimization says we're going to try to track that benchmark, but at the same time tilt towards those countries with these particular characteristics: lower carbon emissions, more renewable energy, greater energy efficiency, and with national climate policies. We're also going to have other constraints on this fixed income portfolio, very important constraints that are put into practice. We want similar durations as the benchmark, and we'll also consider a direct allocation to green bonds. Now, how do we get this data? The optimization problem actually is fairly straightforward. Minimize tracking error, subject to these tilts or constraints. So how do we get the data to which we can apply that tilt? Well, that data in the EU TEG regulations comes from an institution called the Climate Change Performance Index. And this is a group that is a recommended data source for sovereign bonds given by the IIGCC. There are various parts of that index. It looks at greenhouse gas emissions, climate policy, renewable energy, and how we use that energy. There's underlying data under each of those categories. I think that this year is a perfect illustration that renewable energy has to be part of a national policy, as evidenced by all of the European countries affected by Russia and Ukraine. It's now become a geopolitical issue, or renewable energy has to serve as part of a diversified energy source for a country. Okay, let's go and apply this, that we're going to match a sovereign bond portfolio. All right, we're going to track that, but we're going to tilt towards these components of the climate change performance index, tilt towards countries with lower carbon emissions, with climate policies, greater proportions of renewable energy, and using that energy more efficiently. So just for illustration, we're going to take a G6 portfolio: Australia, Canada, United States, Japan, Germany, and the United Kingdom. The first row gives us some statistics on the carbon emissions of those countries. The United Kingdom, among these 6 countries, actually has the lowest amount of emissions per capita. And then we have another group, Australia leading the pack, but not so far behind them, Canada and the United States, with the largest emissions of carbon dioxide equivalents. Now, these are pretty slow moving, as you might see in that bottom graph. So these we can talk about pretty much long-term strategic tilts. They do vary slightly, but these are very long-term strategic tilts in a portfolio. When we look at this type of solution, what really happens is that we're going to track the benchmark as closely as possible, but we're going to upweight countries like the United Kingdom that have lower carbon dioxide equivalents. A comprehensive energy policy are seeking to use energy more efficiently. And we're going to downweight countries like the United States. United States, the country where I live, unfortunately, has been lagging on several of these issues. But with the Inflation Reduction Act, I think this will mean that the United States will catch up soon. A very interesting question to look at is the trade-off between active risk or tracking error and how much we can tilt the portfolio to reduce carbon emissions. And it turns out that we can actually have significant reductions in the proportion of greenhouse gases or carbon dioxide equivalents that we emit. And some of those improvements are very large. So here you can see that we can reduce greenhouse gas emissions by upwards of 40%. We can reduce carbon dioxide emissions by upwards of 35%. If you'd like the total CCPI score, that Climate Change Performance Index score, we can obtain increases in that score of a portfolio of close to 25%. But interestingly, it levels off. And there is a sweet spot that we can actually take 2% tracking error and obtain very large decreases in carbon dioxide. After that, there's actually a limit, much limited room for how much this can improve. So these reductions, they tend to be very persistent, and that's the right-hand side graph. And you can see that these improvements over time with a 1% active risk, these improvements are quite steady in the portfolio. So the summary of this is that, well, we really can make a difference. We can adhere to a sovereign benchmark. We can tilt towards those countries with lower carbon emissions, and we can obtain some very large reductions in carbon emissions. We can green sovereign reserve portfolios and make a real difference. Now, what about performance? Right? A question that you might have is, if I'm imposing these constraints to reduce carbon emissions, if I'm imposing a constraint to tilt to companies, to tilt to countries with better climate policies or greater proportions of renewable energy, well, that's a constraint. How much am I giving up in terms of performance? Well, actually, because we set the objective function to minimize tracking error, the performance of the raw benchmark, just this G6 portfolio in our case, and this Paris-aligned portfolio where we have reduced carbon emissions, it's practically identical. For all intents and purposes, we basically have little detrimental effect of these constraints in performance. So we can reorient our sovereign bond portfolios to be green and to reduce carbon. Now, there's one other area that I said I would talk about as well, and that's actually how to incorporate alpha, actually generate excess returns from climate-aware signals. Well, these are part of a more general set of ESG alpha signals that we at BlackRock have built out, and we have several dozen now different ESG alpha signals. And these alpha signals are exactly that, alpha. They have to increase our return or reduce risk. And I want to show you a couple of them right now. One is whether companies now have issued forward-looking commitments to reducing their carbon emissions. Companies give out some certain types of reports called the Science-Based Target reports, SBTIs. There are also TCFD reports as well. So these are reports where companies have stated that they will reduce their carbon in their operations. It turns out that companies that have done this, that have issued forward-looking carbon commitments, they've tended to outperform. We've shown in this paper and in other research that the direction of causality is not, well, the company makes a forward commitment and therefore just automatically has high returns. No. Rather, the direction of causality is that companies with these SBTIs who have made these commitments to reduce carbon, these are companies that have more traditional quality characteristics. They're more focused on efficiency. They have greater efficiency metrics. So it's rather a company that is seeking efficiency in all parts of its business practice and its production lines. Probably that company would seek to use less energy to produce the same amount of goods or the same amount of services. In Europe, I think you've wanted this badly this year. Because the price of energy is so high, you've really wanted to have greater efficiency among all dimensions of your supply chain so that we can produce the same amount of services or the same amount of goods, manufacture the same amount of goods for less energy production. One statistic that will pick that up, that will be correlated, is if you are using energy more efficiently or using less energy, then that's going to be correlated with lower carbon emissions. And you can see that on the bottom right-hand chart that companies with these forward-looking pledges, they have higher levels of profitability. And that's a traditional quality characteristic. It's because these companies are more efficient and they have this mindset of higher quality. Well, that's actually what's driving that greater profitability. And at the same time, it's also driving lower carbon emissions. And we can see that now on the next slide, and I'll show you that shortly. Okay, the number of companies that have now issued these forward-looking commitments is almost 2,000 companies worldwide. And so there is a great deal now of the issuer universe in corporate bonds for which we actually have this data. So let's show you, well, if you use this as an alpha signal, it's a statement about the quality of a company, and we want to have issuers with higher quality. Let's see how it performs. We have split this up now into investment grade on the left-hand side and high yield on the right-hand side. Interestingly, there is very little effect in the high yield universe. Well, I think that kind of makes sense because these tend to be companies with fewer resources to produce these types of reports or to reduce carbon. In investment grade, it really makes a difference. You can see here that companies that have these forward-looking carbon commitments, it's a signal of quality. Those companies have tended to outperform. So this is an alpha signal. We are using climate data, but actually we're using this data not just for the sake of an ESG outcome or a climate outcome. We are using climate signals to increase the returns in our bond portfolios. All right, so that's the first paper I'd like to look at. We'll come back for questions a little later on. The second paper that I'd like to talk about is allocation to cryptocurrencies. There's a link to this paper as well, but if you'd like to contact me, then we can obviously send out the paper to you directly. This paper has just been accepted in the Journal of Alternative Investments, right? And here's the actual paper. I want to start off with a quote, and this quote is by Thomas Peterffy. Thomas Peterffy is in the Forbes top 100 list of billionaires in 2021. He's the founder of a platform called Interactive Brokers. And he says, I think it can go to zero, and I think it can go to $1 million. I have no idea. And he's specifically talking here about Bitcoin. And our paper embeds this intuition. Most of the time, you're actually going to lose money with cryptocurrency investments. But there is a state of the world in which crypto goes mainstream. It really changes things. DeFi becomes a real thing. Web3 influences our daily lives. And in that scenario, it might go to $1 million, but it has some small probability. So most of the time, we have probably losses. Sometimes we lose money entirely. A small fraction of the time is this positively skewed event that it might go, in Thomas Peterffy's words, it might go to $1 million. Now, Thomas Peterffy, the Interactive Brokers billionaire chairman, advises putting about 1% to 3% of your wealth in cryptocurrency. And this advice is also echoed by Ray Dalio, who just retired as from his firm Bridgewater. Ray Dalio is on the Forbes top 100 billionaire list of hedge fund managers. And he also says that allocating up to 2%, so 1 or 2 or 3% of your portfolio in cryptocurrencies is reasonable. All right, so we started off with some quotes. We started off with this intuition about probably losing money most of the time, but sometimes it might go to $1 million. The thing about cryptocurrency, yes, it's very, very volatile, and yes, it has a very high mean, but actually that's not the interesting thing about cryptocurrency. So here you have some tremendous returns for cryptocurrency. These correspond over here to amounts of about $770,000 for $1 invested in July 2010. Right? And that corresponds to single figures like $4 or even less than $2 in capital appreciation for investing in stocks and bonds over that same 10 plus year period. So yes, the returns have been spectacular, but the returns have been extremely volatile as well. And that's what I want to show you here. So these are some summary statistics. They're so skewed that we actually have to use log returns or continuously compounded returns. So the volatility of Bitcoin is 132%. The downturn that we've seen in crypto this year, the crypto winter, you can easily lose half your money in a given year, easily. In fact, you can lose almost all of your money with 132% volatility. Now, what's kind of interesting is the second last column on this slide, which is the third central moment. The third central moment is 144% for Bitcoin, which is several orders of magnitude larger than the central moments for equities and bonds. Equities, we know, has a left-hand skew. Equities periodically crash. Our most recent crash was in the first quarter of 2020 due to COVID. So there's a negative sign there. And bonds have basically zero skewness, at least in the third central moment. The last column is normalized skewness. So it takes the third central moment in the second last column, and then it divides through by volatility to the power of 3. What's interesting is that that skewness is approximately the same order of magnitude in absolute values across these 3 assets, Bitcoin, equities, and bonds. But what really is important for asset allocation is not the normalized skewness, but actually the second last column, which is the third central moment. And that Bitcoin in that third central moment is extremely right-hand skewed. We're going to do several other things. We're going to build in the positive correlations for equities and Bitcoin that you see here. And I'm going to proceed with a 3 asset allocation model for equities, bonds, and for Bitcoin too. All right, now the way that we're going to model Thomas Peterffy's intuition, that we're going to probably lose money most of the time, but in a very rare state that's not frequent, we might go to $1 million. And I want to show you that in a picture. Okay, so Bitcoin has extremely wide tails, right? It's got this volatility of about 140%. And that's the black line that you see on the left-hand slide, on the left-hand graph. Equities and bonds have much tighter volatilities, right? These are volatilities of around 15 to 20% for equities and about 8% for bonds. So they are in the very, very narrow density. Now I'm going to take that black line and then I'm going to blow it up. And so the Bitcoin density is what I actually see on the right-hand side. And you see in that right-hand graph that I have a data estimate of what that probability density function is. That's the dashed line. And that shows you that there is a right-hand tail. That right-hand tail, these are in log returns. So e to the power of -2, it's like you've lost most of your money, right? Basically, you've lost everything. E to the power of 3, e to the power of 4, these are returns in the hundreds of thousands. There are some states with that right-hand tail where literally Thomas Peterffy is right. It could go to millions of dollars. And that right-hand tail is quite special. We're going to fit that distribution by a mixture of normals. And the mixture of normals, most of the time, you're going to have very, very wide returns, and you're probably going to lose money. But we're going to mix it and combine it with a Bliss distribution where it's going to fit the right-hand tail, where we might have some still volatile returns, but they're going to have a very, very high mean. Thomas Peterffy's go to $1 million. Now, at this point, I'm going to comment that it's actually quite rare to find an asset that is so right-hand skewed. Most of the assets that we deal with, in fact, your whole business, is really dealing with left-hand tail events. Equities crash, real estate crashes, high-yield bonds crash. We also have left-hand skew for most of the style factors that have been a majority of my research for my career. Value has crashed. In fact, we're going through the biggest value drawdown, still climbing back up from the downturn that started in 2018. But the renaissance or the recovery started in 2021, and value has beaten growth year to date as well. Carry crashes. Hedge fund strategies, generally like short volatility, they also crash too. Those are precisely why we hold, as you do, these reserve portfolios. It's rare to find an asset that is the opposite, right-hand skewed, where actually instead of crashing, we have these crash ups, right? Not crash downs. But sometimes there are these rare events that we're going to actually literally win the lottery. So I'm going to show you now that mixture of normal distributions that can fit this distribution of Bitcoin, that most of the time we're going to lose money, but there's a bliss state that sometimes we're going to, in Peterffy's words, go to $1 million or more. All right. So this is what this data generating process looks like. On the left-hand side, we have 2 normal distributions which are in the dashed line. We have a normal distribution that has a lower mean, right? So that's the blue normal distribution. And most of the time, in fact, empirically, 96% of the time, we're going to lie in that distribution. Very large volatility, right? These are all log returns here. So e to the -2, e to the -3, you have literally lost almost your entire portfolio. There is another regime, and that's given by the green distribution. Now you can see that that normal distribution gives us how that we can fit the right-hand tail. the crash up type of events. And that green distribution happens infrequently. In our empirical estimates, it happens only 4% of the time, 3 to 4% of the time. But if it does, it has a monstrous mean of 4.67%. 4.67 times, that's 467%. But most of the time, we're actually in that normal distribution on the left, that blue line, and where we potentially could lose our shirt. Okay, so this is the intuition that we have. Most of the time, we're going to draw from this normal regime, but there's an infrequent draw from bliss regimes with a very high mean. Still volatile, but with a very, very high mean. Now, what does that mean for asset allocation? Okay, so we could actually go through exactly and calibrate this and take some utility function, then find out what the optimal weights are. And we actually do that in the paper. But what I would like to show you today is I want to show you the sensitivity of allocations to Bitcoin varying that small bliss regime probability. So empirically, it's 3 to 4%. But what if it was actually much smaller? Or what if actually going to that bliss regime had a much larger probability? So that's what I want to show you next, is the sensitivity of an allocation to Bitcoin varying the probability of the bliss state occurring. All right. The way that I'm going to do this is I'm going to start with a 60-40 equity bonds portfolio, and that just happens to calibrate our risk aversion parameter. And I'm also going to do a few other things. I want to set the mean of that normal distribution during regular times. I want to set the mean to losing money most of the time. So I'm actually going to set the mean to correspond to a 50% loss in that regular regime. Okay, so this is pretty extreme, but I'm going to do but it reinforces the point that in the normal regime, the regular regime, we're going to basically be losing money almost all the time. If we have a small probability, which is graphed now on the x-axis of this figure, if we have a small probability of going to bliss, of getting these literally $1 million returns, how much of that asset should we hold in our portfolio? So we're going to take that 60-40 equity bonds and we're going to hold that pro rata, and then we're going to introduce a little bit of that Bitcoin asset, but how much you introduce is going to depend on your belief of going to bliss. You can read off the probability of bliss and then the actual weight in the y-axis of our portfolio allocated to Bitcoin. So a 1% Bitcoin allocation corresponds that you need to believe that 3 out of every 1,000 events, you're going to go to bliss. If you hold 2% in your portfolio of Bitcoin, you need to believe, actually there's a typo in there, this should be 0.005. So this is about 5 in every 1,000. And then 3% Bitcoin, well, you need to believe that approximately 1% of the time you would go to bliss. This is quite intuitive. The greater the probability that you think you're going to arrive in the bliss regime with the really high returns, the more Bitcoin that you're going to hold. But the point is here that you don't need to have extravagant beliefs on that right-hand tail, right? 0.0003. Only that very small probability of going to Bitcoin would justify the Thomas Peter Fee and the Ray Dalio advice of holding about 1% of your portfolio in Bitcoin. This is actually the complete opposite of what we're used to in financial markets. We hold less equities generally because we want to be less exposed to a drawdown. We hold less hedge fund strategies because we want to avoid the probability of a hedge fund crash, right? We hold less high yield because, well, if we go to a recession and credit spreads blow out, we don't want to have such exposure to high yield losses. Here, a very small belief, but is causing allocations to an asset that might actually be a proverbial lottery ticket. All right, so this is an exercise that we've done corresponding to what's called power utility. Power utility, interestingly, is locally mean variance. So what that means is that for most assets like equities and bonds, mean variance gets you actually the same asset allocation as power utility. Bitcoin is not mean variance. Bitcoin has a third central moment of 1.43. I showed you the third central moments for equities and bonds, which were in the 4th decimal place. So you can't get any of these effects with mean variance, despite power utility being locally mean variance. So we get the same answer for stocks and bonds. Bitcoin is so positively right-hand skewed that a very small probability or exposure to that game-changing, life-enhancing event of that right-hand tail causes you to hold just a small amount of Bitcoin in your portfolio. Here, the risk is not a stock market drawdown. Here, you want exposure because there is a small risk, a small chance that actually you make literally millions on that particular position. It's the complete intuition, opposite intuition of what we're used to in general finance. I want to consider one other utility function, which comes from Daniel Kahneman and Amos Tversky. And they created cumulative prospect theory. Amos Tversky, if he were alive, would have received the Nobel Prize together with Daniel Kahneman. And there are some great books written on Tversky and Kahneman, including a popular fiction, a popular non-fiction book called The Undoing Project by the best-selling author Michael Lewis. Now, Kahneman and Tversky concentrated not on theoretical power utility or mean variance utility. They formulated something about what people actually do. And what people actually do are these 4 components. They care more about losses than gains relative to a reference point, the losses being particularly bad. They're more sensitive to those losses. They become risk-seeking over losses. So if you've got nothing to lose, you actually, it's like an animal that's cornered. You just lash out. If you've lost enough money, then you've got nothing more to lose, so you actually take on more risk. And the last one is particularly pertinent. That is, you overweight low probability events and you underweight high probability events. Now, most of these features are already captured by what we looked at before. So power utility, it does treat gains and losses symmetrically, but nevertheless, there is some aversion to risk across those. You can separate the gains and losses, but it's really the same effect as we saw before. What's new for what people actually do with cumulative prospect theory is the last one. We go from probabilities to decision weights. And agents with cumulative prospect theory are extremely sensitive to this low probability, ultra high return bliss state. And that's what I want to show you right now, right? This is the final graph, and this shows you the probability of the bliss regime and then the optimal holding of Bitcoin. We're going to start off with a 2872 equity bond portfolio, and we've worked with that because these are actually the original Tversky and Kahneman parameters that correspond to a 28% equity, 72% bond portfolio. We're going to hold that pro rata, and then we're going to introduce that Bitcoin asset. In the regular regime, we're going to set the mean to correspond to a 90% loss, right? So literally almost nine out of 10 times, you're going to lose money. You're going to practically lose everything. There is a small probability that you will go to bliss. And it doesn't take very much. The right-hand side just pulls out some numbers from that graph. And so you can see that if I change the probability of going to bliss from 0.0005 to 0.0006, I basically more than double my Bitcoin allocation. If I change it to 0.0016, right, you can see on the right-hand side that we've changed the Bitcoin allocation from 1.3% with 5 in every 10,000 events to 17.8% Bitcoin holdings. It's extremely sensitive to small changes of that bliss state. My final comment is that this is exactly what has happened over 2022 crypto winter. People have revised their probabilities that we're going to bliss. And most investors actually have revised downward that probability of going to bliss. Well, if they revise it downwards, then what happens to their Bitcoin allocations? Well, they go actually upwards now. Instead of holding 20%, where you hold this belief of 0.0016, you basically sold all of your Bitcoin allocations with moving that probability of belief down to 0.0005. So that means that your Bitcoin trading is going to be absolutely enormous as investors revise their beliefs downwards in 2022, causing subsequent falls in the price of cryptocurrencies. And that's exactly what we've observed in this year's crypto winter. So in summary, what's this all about? Okay, so we have now with cryptocurrency a small probability of receiving a massive windfall. If we have such a small probability, we're going to have that imply it might be worth it just to hold a small allocation to these cryptocurrencies in your portfolio. They are literally lottery tickets. And we want actually exposure to these right-hand tail events. They're quite rare. There are very few assets in finance with these right-hand tail skews. We want exposure just in case the risk is that it does become the next big thing and it completely goes mainstream. We want to actually have a little bit of tiny exposure to that. The flip side, though, is what we've observed in 2022. If we revise those probabilities of going to bliss, then the Bitcoin allocations that we have in our portfolio are going to be extraordinarily sensitive to subjective beliefs about what that probability of the bliss state is. Thank you very much, and I will open up for questions here.
Thank you very much, Andrew, for all these insights and that you actually are able to turn into actionable investment advice. So let me, we only have over 10 minutes for questions. So let me start with some questions. We have also received questions from the audience. We will try to cover as many as possible. So let's focus first on your Sustainable Alpha paper. So the question, and I think probably related to the audience here, most of the people in the audience, they have very significant allocations to US Treasuries in particular, right? So they have government portfolios, but they have a significant allocation to Treasuries because of the liquidity needs and the importance of the dollar, et cetera, et cetera. The question is, I mean, what are the limits in terms of liquidity that you may find, for example, because your methodology sort of creates biases to countries that have relatively small markets. Let's say, for example, Scandinavian countries are very good in terms of carbon emissions, right? But they also have relatively small bond markets. I think that's also, I'm also trying to address a question from Daniel Resk from Uruguay, also about the impact and the liquidity considerations of your approach to Sustainable Alpha.
Yeah, this is a great question. And this is why I like this approach of starting with a model portfolio or a portfolio without any climate considerations or a benchmark, right? Just an off-the-shelf sovereign benchmark. You start there and then you tilt and you take tracking error in different ways. So I said that you can impose a tilt to countries that have lower amounts of carbon dioxide emissions. We can also impose constraints on that portfolio. I said, well, we would like duration constraints or DTS constraints, which we have put on. And I think this question says, probably liquidity constraints would also be built into that optimization problem. And then I would actually let the optimizer take care of that. We're trying to track that benchmark or that portfolio without the climate considerations as tightly as possible. But we want to do that simultaneously to decrease carbon and maintain liquidity, duration, DTS, and other bond portfolio characteristics. So I do think actually the optimizer can help in that trade-off. We can impose it as a hard constraint, we can impose it as a penalty function, and sometimes we might even approach it as a particular screen or build it into the benchmark itself. So what I like this approach because it's very flexible, and other things that are very important for an investor like liquidity can be built into the optimizer.
Thank you, Andrew. And let's discuss a little bit the impact of this strategy, because you suggested at the beginning of the presentation that the final objective is to reduce carbon emissions, create a portfolio that reduces carbon emissions. So the implicit assumption is that by reducing the allocation, if all investors reduce the allocation to a particular government, let's say a particular sovereign, they will start implementing, let's say, cleaner practices, and they will start implementing ideas in terms of carbon reduction. So what do you think about this? I mean, do you think that this is a real impact? Do you see that an eventual increase in borrowing costs can actually, I mean, induce a country to be more proactive in terms of climate policies?
I think today that that question is all about who's the marginal price setter in that market. And I believe today that those types of climate and ESG considerations are not priced in, or they're not considered by the marginal agent in these markets. Would there be a time in which those types of considerations might be priced or might be considered by the marginal agent? Maybe, but I don't think it would be today. So I think these climate considerations, these are multifaceted, and the climate change performance data, the CCPI, Climate Change Performance Index data, does recognize these different areas. So some countries might have large amounts of renewable energy and consequently lower carbon emissions, but their past and current energy use is very high. Or they might have, as in the United States, there is a significant amount of renewable energy, but probably the climate policy of the United States is lagging other countries. And so there are different trade-offs. We have put into our Paris-aligned or climate-aware fixed income portfolios, we have put in the actual CCPI score, and we seek to improve the CCPI score of the portfolio across these multiple dimensions as another dimension. So it's not just, I think, about reducing carbon emissions, but that certainly has to be one of the most important considerations in climate-aware sovereign bond investing.
Thank you, Andrew. Now let me take a question from the audience. Actually, Javier Bonsa from Colombia, he's asking a question. I think it's probably going back to the first question regarding the methodology and the constraints that you impose. So have you considered that, I mean, the possibility of actually doing something similar, or the impact when including, for example, emerging markets in the exercise? Would you have better results? I mean, would you still be able to have a reasonable tracking error relative to the benchmark if you also overweight certain, let's say, more emerging markets that rank better in terms of CCPI?
Yes, we have applied this to emerging markets. And again, I think one of the attractive features of this type of framework is it can work. It's a methodology, and so it can be applied to any particular fixed income benchmark, to any fixed income universe, or to any type of model portfolio, including a model portfolio absent climate considerations that you have constructed. So what happens with emerging markets is the actual proportion of greenhouse gas emissions is necessarily lower in the amount of reductions that you can receive compared to developed markets. That's probably quite obvious. The tracking error also needs to be wider, I think, to obtain some significant reductions in carbon emissions. I showed you some figures that a 1% tracking error can get you reductions of carbon emissions by upwards of 20 to 35%. That's not feasible in emerging markets, or you have to obtain much larger tracking errors in order to obtain some of the same reductions in greenhouse gas emissions. But largely speaking, the methodology can be applied to any type of fixed income constituent or any fixed income universe, including emerging markets.
Thank you very much for that. And let me address a final question on this topic from Eduardo Hoyos from Colombia. The question, of course, you're focusing on one measure, but of course, in your day-to-day work, in general, you're focusing on sustainable investment. So what other, let's say, ESG measures would you recommend in terms of application to responsible investment and asset allocation?
Yes, we are primarily interested in the ESG data, including climate signals, for the purposes of predicting returns. We are after it for alpha. We showed you a climate signal, which is the forward-looking commitments by companies. These companies or issuers are higher quality, and we have outperformance of bond portfolios. We're interested in ESG. Okay, it's not just for the sake of ESG. We are interested in ESG because it affects risk and return. We've written several other papers with different ESG predictors. I'll just give you my favorite type of few lists now. Because of the war between Ukraine and Russia, one of the signals that has performed very well this year is companies with higher proportion of veterans have outperformed. And veterans are a diverse workforce. They have skills that I certainly don't have. It turns out that companies, defense companies with higher proportion of veterans are awarded more government contracts. So it's not only a diverse workforce, but there are real effects on profitability. There's a strong sector element to this. So defense companies have done very well in 2022, not surprisingly with the conflict on war in Europe. But there are lots of other companies that hire veterans as well. In my group, in the Factors group at BlackRock, we count one former captain of the British Army and one former captain of the United States Army. BlackRock hires veterans, and many other financial firms and utility companies do. So it's not just defense. We have a signal on corporate culture. Corporate culture, I think, is a really nice example of S. Companies with the best corporate culture outperformed in 2020 and 2021. We proved that we could do business remotely, and I think the most effective companies doing business remotely were those companies with very strong corporate culture. We estimate corporate culture by machine learning, so we do textual analysis on conference calls of companies. So there are 10,000 conference calls a year, and we do a process called word embedding that identifies a dictionary of words related to corporate culture. We've seeded with 5 keywords, and those are pillars of innovation, integrity, quality, respect, and teamwork. But we build a dictionary, and then we count the frequency of those words occurring during a conference call. So those are just 2 examples of the many dozens of alpha signals for ESG. But we are doing this. We select these ESG things, just like the example I showed you for the fixed income corporate bond portfolios. We are doing this because we believe we can generate excess returns.
Thank you, Andrew. And let me ask you a final question. We're running out of time. So a final question on your paper on asset allocation with crypto. So the question is, you actually focus and you see a lot of value in terms of including crypto, for example, in the asset allocation for investors that have a bias towards, let's say, positive skewed actions. Now, when we're talking about official sector investors, it's usually the opposite case, where they are really concerned about left tails and negative skewness. So do you still see an application for official sector portfolios of your findings?
Yeah, that's a really good question. And I think the main purpose of reserve portfolios, it's exactly for the left-hand tail, rather than the right-hand tail. There may be a diversification benefit for holding these types of very skewed right-hand tail strategies, but it certainly would not be appropriate for the state of the end of the world. We need a protection at all costs element of reserve investing. But there are some portions of the portfolio that are more growth oriented, and because of the diversification that these things would have, may be considered. If you do consider them, though, it could go to zero most of the time. But there are sometimes might be a state of the world, there's very small probability that you might consider it.
And thank you, Andre. And I'm trying to address all questions from the audience. So one very concise question, so which is basically related. I think you touched upon it, which is rebalancing. So actually, we received a question from Venezuela regarding rebalancing. So dynamic rebalancing of your strategy. So you mentioned the change, and we're seeing also change. Probably the future distribution of returns of cryptocurrencies will be very different from the past distribution. So how would you approach this issue of rebalancing over time? Allocations to crypto?
Yeah, so there are two, I think, important aspects of this. So the first one is I don't recommend you just hold one cryptocurrency. You probably should hold a portfolio of them. Now, if you do hold a portfolio, that means there are cross crypto strategies that you can do. And in fact, there are several papers, and at BlackRock Systematic Algo Group has been working on several different crypto selection, individual crypto selection, like security selection, or cross-sectional systematic strategies. So there are value effects, size effects, momentum effects in crypto. So actually that's alpha for your crypto portfolio. So I think there's the results here are slightly conservative if you did a portfolio instead. The second one is, this is historical data. I absolutely acknowledge that. And if it does change the world, if there is a bliss state and crypto becomes literally in everyone's wallet, like it's a hot or cold wallet rather than an actual physical wallet that you hold in your back pocket, probably the return distribution of crypto would also change. In fact, the whole reason it's gone to bliss, so you enjoyed the very high returns. Now that you're in bliss, the returns are probably going to be much lower because it's already gone mainstream, right? It's the small probability of it really being adopted and being game-changing, right? That's leading to that bliss state. Once you're in bliss, probably the return distribution would look completely different. And that's the big question. So in equilibrium, if it does, if the bliss state does occur, then what would the return distribution look like? I can probably say, confidently, it's not going to look like the path that got you to bliss.
Excellent, Andrew. So unfortunately, we're running out of time. I have a lot of questions to ask you, but unfortunately, that will be for a future opportunity. So thank you very much for your time. Thank you very much for your insights and for sharing your views and your research with the audience. And thank you very much, Flower, for this invitation.
Thank you.